Hey guys, good to see you. A lot of familiar faces here. Some of the guys I work with, some of the guys I might work in the future. Quick introduction about me. I'm Pulkit. I work with Nomad Capital as an investor. It's a SF-based fund. We do all kinds of investments from on the VC side, whether it's on the it is related to DeFi, whether it's tokenized funds, whether it's stable coins. We look after multiple things. And we have been working with a few of these guys already. Would love to hear what you're doing, David, at Fasanara, Meredith at WisdomTree, and Henrique at Symbiotic.
Yeah. Hi everyone. David Vatchev, head of tokenization at Fasanara. So Fasanara is an alternative asset manager focused on private credit, but I'll be careful when we say that because there's quite a few discussions on this today. We do asset-backed lending, which is invoices, financing, short duration cash flow, not over-leveraged long-term loans to software companies, just so we're all on the same page. But we're also quite unique in that we have a digital asset arm as well in Fasanara Digital. So we've been deploying into crypto since 2018. So we're quite unique in being an FCA-regulated asset manager, having both an RWA side and an on-chain crypto side. And I sit at the intersection of the two, so really packaging RWA yields and coming up with tokens and designs to bring them on chain to make sure that they're valuable collateral and actually get productive use. So really excited to be part of this panel.
And hi, everyone. Great to see you all. I'm Meredith Hannon. I lead business development for WisdomTree's digital assets business. And especially for this panel, very, very timely. And I have my legal colleagues here, too. So kudos to them. We have now secondary market liquidity for our money market fund. So for us, we have 15 tokenized products, a money market fund, which has primary and secondary liquidity, as well as a full fixed income asset class of 6 different products, 2 equity products, as well as a private credit tokenized fund as well, but a little bit different in that the underlying is not those longer term dated quarterly types of redemption cycles, but actually the underlying trades like an equity. So it still gets that T+2 liquidity that most of us are looking for in this space, but with the risk profile and also the yield of what private credit you would expect from in that asset class, as well as an equity premium product. So really focused on the short term cash equivalents of a money market fund that can be used for collateral, that can be used for payroll, that can be used for small to mid-sized businesses to get yield, while also focusing on more higher yielding products that are really attractive, especially as we start to talk about DeFi and what's available in the looping type of space. So both institutional and retail investors can utilize our products, and WisdomTree is a $150 billion asset manager. We've existed for over 20 years, focused on ETFs and ETPs, and we really see tokenization as the future of finance, and looking forward to talking a bit more about what that means.
Hey everyone, I'm Henrique. I'm a protocol specialist at Symbiotic and the product lead for anything RWA related. Symbiotic is a vault-based collateral management platform on Ethereum, and we are now upgrading the infrastructure that we have essentially to provide liquidity for long-duration assets, including some tokenized private credit funds, money market funds as well, and essentially any asset that needs liquidity on the secondary market.
Got it. Thank you. Got it. Thank you so much for the intros. All of you have been building in this space for many years. Some of you are OGs for 20. You have been here for 2 decades. At Fasanara, there's like focus on the private credit. At WisdomTree, you've been focusing on multiple things. At Symbiotic, it's restaking infrastructure as well. So how do you see for 2026 the capital formation will happen? I mean, on-chain transactions, on-chain credit, how is that going to happen in this particular year? David, you want to go first?
Yeah, sure. So yeah, we the way we look at this approach is how would our crypto fund effectively interact with something that's on chain, and where the actual yields and the return profile is off chain. So a lot of people say, well, if it's private credit, name your thing. But the problem they're really solving for is they can't credit underwrite things that are off chain. So everything looks great, but the recent hacks within DeFi, which are obviously a recurring theme, have showed that the entire investment community the need for productive economic cash flows linked to real-world activities. Now, the problem with that is, how do you then understand what that instrument is? How do you understand whether you have claims to the collateral? How do you understand whether that yield profile is real? So how we look at things in the evolution is, how do we evolve into a more holistic on-chain asset manager? So how do we combine the yields that we get from TradFi and RWAs, package them into tokens that can be productive collateral within DeFi? Our first token, MF1, is already being used in Morpho, and we've just recently launched M Global, which is soon to be live on Horizon. And the goal then is to evolve that. So not just contributing with RWAs, but what can we also be doing to make that a more holistic go-to-market effectively on chain? So how can we be curating some of these vaults? It's been great to start work with the team of Symbiotic to kick off that process. How can we be lending USDC into this? How can some of our crypto funds be lend looping some of these? Because the way we see this is the real game changer is that how can you combine the best of both worlds here? And very few asset managers are looking at joining the two together.
To take another step in a bit of a different direction, I think for us from a strategy perspective, we're very focused on utility. And what that means is bridging TradFi to DeFi, but practically that means having the rigor, the regulatory status, and the structure of traditional assets and funds with the accessibility that you would expect from a crypto native asset. So what I mean by that is, for example, our money market fund is a standard structured Rule 2A7 40 Act fund effective with the SEC, but it can earn continuous interest accrual. That is something new and different that you would not get from a traditional money market fund. You can also now trade it 24/7. That is, again, something new and different, enhanced utility than what you would get from a traditional money market fund. So we're really focused on creating new utility in this space that makes all of our tokenized funds a step function above and better than what you can get today in your standard brokerage account. Because I do think that's a big pushback from mainstream is, how is this better than what I can get today? So we're very focused on really delivering that to the end investor. And I would say too, beyond just the DeFi spaces, which obviously we're happy for our products to enter into in a permissioned way, we're really focused on real world use cases. So whether it's being able to be paid with a yield-bearing money market fund in payroll, whether it's for small to mid-sized businesses to be able to start really utilizing their underutilized cash or effectively stable coins and earn a yield onto that. Collateral use cases as well, to be able to go and post them on different venues, utilizing our funds to, again, be able to make other trades. So thinking about those connective points, and I think for this conversation it's particularly important because as those utility items are really seen, that's going to bring new investors into this space and to really say, oh, this is a bit different than what I can get today. And I think that's what's going to be really powerful. And I think we'll also see more and more, and this is a big thing that we do with WisdomTree Connect, which is our institutional platform, as well as WisdomTree Prime, our retail app, is that all the complexities of blockchain are abstracted away unless you want to manage your own wallet, hold your own keys, etc. But to make it as easy as possible for more mainstream users to come in, both through enhanced benefits than what they would have today and just an easier access point and experience.
Yeah, so on the Symbiotic side, we focus on the capital efficiency of the vault strategies. So the infra has been built and we are now onboarding great curators, including Fasanara as well. And our main focus is, as I mentioned, to make those strategies as attractive as possible. And we are effectively whitelisting new yield sources that curators can benefit from. So previously, a simple strategy delegating capital to a simple DeFi protocol would be enough for the DeFi users. But now it's not enough anymore. So our focus is building DeFi composability within the vaults. And that means that yield can come from multiple sources, including the existing Symbiotic natively integrated applications, can come as well from the lending markets, the risk-free rate, can now come as well from discounts at which RWAs are acquired effectively, and soon some arbitrage strategies as well. So if we combine all those yield sources without increasing the risk substantially, that's how our capital formation would effectively be enough and more attractive in DeFi.
Got it. No, that's a great answer. I think another thing we have been seeing is that right now the secondaries are still trading far behind. And in terms of primary trading, on the primary issuance side, there's like a lot of traction. How do you see that coming in the next 1 or 2 years? And how do you think like secondaries will trade in this particular market?
Yeah, I can start. As somebody who's effectively now starting secondary trading on one of their products, it's interesting, and we've seen this with many times before, actually even off-chain. One of the main reasons why it's actually very difficult to do this, if you look at a traditional market maker like a Wintermute, a GSR, a Cumberland, name it, why can't they simply, instead of all of the actions they perform on crypto, why can't they do this off-chain? And the main reason is they can't credit underwrite this. It's completely, a private fund is private for a reason. We have a verified fund administrator who's a third party who goes and values this. So it's very difficult to actually bridge this. But what will happen is, as the market becomes more comfortable with the underlying collateral and can see the track record on chain, can see the mechanics working, just as we're talking here, can see added utility, can see added benefits, and can see consistency of yield with minimum volatility that tracks with the actual TradFi investment, more and more people will be able to backtest that data and understand this is the right price. And we are happy to take some duration risk in the meantime here, because the NAV isn't going to move over the next sprint. But that will require a process. Now, you can see this evolving with tokenized stocks, which have blown up. A lot of that, just what we're talking about utility, is an accessibility thing. Many people in China can't access NVIDIA. This is a great purpose. And obviously as well, it's very easy for somebody to have a secondary market for something which they can see a live price for. So that market starts to evolve. And more is that's going to start happening to a broader range of TradFi products.
Specifically to your question around 1 to 3 years, I think we're starting to see this, and the example I gave before was our own money market fund. We now have 24/7 trading on, creating that secondary market, but we are still the broker dealer. So we are still needing to post that capital for both the buy and the sell side. And again, we're hoping that that expands over time, and that's something that we're very focused on. But especially having regulated 40 Act products, we need to go to the SEC, we need to get exemptive relief, as I've mentioned. So it's definitely building out the ecosystem, but it is a step-by-step type of a process. And there also needs to be seen demand on the other side. So to the point around you're building this market, there needs to be both buyers and sellers. So I think that's a really critical part over the next year to 2 years, is to find those buyers on different platforms. Maybe it's internationally, maybe it's also just getting more, again, mainstream adoption through distribution and connecting into existing channels that they have no idea that they're necessarily interacting with a tokenized product, but it looks and feels like any other token that they may, or fund or equity that they may already have. So I still think we're at very much the beginning stages of it, but as you start to build it step by step, that's where more people will come and interact with it, and then that's going to enable us to do more and more products beyond just our money market fund.
Yeah, that makes sense. I agree as well, and we can be the buyer there, actually, so we can discuss that as well. But so effectively, the primary market needs to work for sure, and the problem that we see there is that sometimes it can happen that you subscribe and you want to get the access to the asset, but it may take, and you may receive it on a T+5 basis or something. So it's not good when you try to acquire it, but it's even worse when you try to get rid of that. And like some of those products can take up to 90 days to be redeemed. So we believe that for those tokenized funds and assets to scale up on-chain, they will need a proper secondary market as well. As David mentioned, so we wouldn't expect the market makers to have the capital available to acquire them when necessary, and their cost of capital is also higher than what retail users get, for instance. So on our side, we try precisely to enable that risk duration transfer from, let's say, the market makers to the Symbiotic vault stakers. That's possible because they have different risk profiles as well and different yield sources that they can benefit from. So effectively, if we transfer that risk, then we can make sure, or we can have more liquidity guarantees for those assets to be traded on the secondary market.
Also, like for this particular cycle, what do you think institutional allocators are looking at? And I mean, what's their main focus? Is it around the yield side? Is it around the transparency side? Is it around uh, the security side? What are they trying to look at when they come and invest their capital with you guys?
Yeah, it's an interesting question because this year is quite unique in many things that have happened. So obviously security and risk are probably the elephants in the room where everyone's looking. But I think on the flip side of that is also they have realized, especially for RWAs, the real benefit from them. So a lot of the product market fit initially came from a direct utility in the sense that interest rates were obviously higher in TradFi versus DeFi rates in 2022, so it was immediate product market fit. Now we're seeing productive collateral, and it's expanding to more and more use cases, which is great. But first and foremost, security and recourse are by far the biggest thing, because what happens when something goes wrong? And people have really realized the composability of DeFi obviously works both ways. So that's first and foremost. But I would say that as well as looking at these, the opportunity is still vast. If I have a fund and I wish to call Goldman's or a prime broker to try to get leverage against that, it would be a very, very time-consuming, if not impossible process for some funds. Here, I can simply deposit it in a lending protocol and USDC is just thrown at me. This is transformational, and the more and more of these use cases that start happening on chain, more and more allocators will start looking at them and we'll start to see the ecosystem grow.
I agree. I think on the yield front, that's still very much a focus, but I would also say it's measured against volatility too. So there is a real focus on volatility. To add to your recourse of what if something goes wrong, I think over the last 12 months, and especially over the last few months, we've been getting asked the question more and more, how is your fund structured? Who's actually the ownership? Is it bankruptcy remote? Can you provide a prospectus? Things that I was not being asked, 12 months ago, has become more and more into focus in terms of what's the transparency of the underlying holdings, how quickly can I enter and exit, these types of fundamental operational questions that are very commonly asked on the traditional side are now more and more entering this space as people are concerned about what they're actually buying and understanding what they're holding.
Definitely, and we've also seen that curators are taking longer now for their due diligence process as well. So it kind of makes sense because we saw all these vulnerabilities in the past few months, and that's necessary. We agree and we understand that as well. But we also need more yield products that have their yield uncorrelated to the DeFi market in general. So for instance, like Ethena used to pay double-digit APYs, and it's like lower now for sure. So we would expect, and we are observing that in the market, that some players are trying effectively to tokenize some products that have yields more uncorrelated to DeFi in general. And we are exploring this with a few of them. Could be something related to insurance, for instance. So companies that want to rely on capital on-chain to underwrite policies and risks off-chain, because the cost of capital on-chain would be also lower than what they would be getting on the off-chain space. So I would say that definitely risk, security measures, longer due diligence process would work here on the security and transparency side. But if we can also improve the yield and the structure of the products, then more capital would flow to, in this case, the Symbiotic vaults, but to other DeFi products in general.
Yep, I've said this, I think, a lot of times today in this cycle. I think everything is just changed in the last 1 quarter. I think the Resolve protocol hack and then this Aave thing again. On that side, how do you see the capital formation happening on chain? And what are the main bets that you're taking on this side? Personally, from your fund side, what are the main focus areas for you?
Yeah, it's a risk-adjusted return, right? So as we've said this before, it's actually healthy that this happens, even though it's what DeFi is really designed to do, and how this process is managed, the ecosystem evolves. Now, what it also does shine light is the multi-billions that are out there effectively lending into DeFi at less than 2%. Like, you'd have to be insane to be able to put your capital at risk in that for that type of yield. And so just to the points we were discussed before, people are looking for yield, but at the same time, they are looking for consistent yield with minimum volatility, which is highly granular, diversified, and uncorrelated to crypto. And that's actually what they're looking for. So ultimately, that stability of NAV and the consistency of yield profile that isn't going to move is extremely valuable within on-chain. So to answer your question about bets also, what we're taking is that, and we have seen this factually, there's been more and more demand for RWAs. And as products and structuring evolves, both from the actual legal structuring side of things and in terms of what the market wants on chain, you're starting to this convergence and growth of different products, different asset classes that all fit different purposes. And we've talked a lot about DeFi, but there's yield-bearing stablecoins, there's on-chain wealth management, there's entire industries which are effectively growing and evolving. We'll continue to see that.
And completely agree. I would say for us, it's not necessarily a new bet, but it's a bet that we made probably about 5 years ago as we launched a lot of these funds 2 or 3 years ago. But completely agree. And I think particularly for us, thinking too about the underlying liquidity of, meaning the actual liquidity that of the equities and the bonds that our tokenized products are being held. Because again, a question that probably a year ago wasn't being asked, but saying, could I place a $500 million trade and get out of that $500 million trade in that same week? That's starting to be more and more important for the underlying liquidity of the market. And that's not necessarily what's on chain, but it's also what's off chain. So I do think that's also been a new type of theme that's been coming about. And I would say just more broadly, our focus has been on RWAs and really spearheading a lot of that. And I think in a never want to see anything bad happen, but we've actually been very well positioned to take on some of these assets that are seen as more a safe harbor just because of the structure and what we've built.
Yep. So on our side, the focus has been mainly on the liquidity side of things. So I wouldn't say a bad, but our focus has been along those lines, effectively because we understood that those products to scale properly on-chain would need secondary markets and liquidity available for them. So anyone that wants exposure to that type of product would be more comfortable and would likely deploy more capital if they have more liquidity guarantees. So they would know that if they wanted, they could exit atomically instead of waiting for the 90-day period or even more than that, still exposed to the NAV during that period of time. So we understood that assets would need it, so we built the infra to precisely allow that duration risk transfer between, let's say, market makers and vault stakers, and effectively has been our focus, and we plan to whitelist more assets now for curators to benefit from.
Got it. I think this particular question will be a bit different for you guys because crypto changes, I think every single quarter there's something new happening. So what are the big things that you're seeing 5 years down the line? I know 5 years is a long time for us.
This year has felt like 5 years.
5 years.
So it's been a lot of change.
Bitcoin has touched 82K, so that's a good thing, finally. I mean, 5 years back, I was trading on meme coins, and I was losing out on cash back then, and now I lose cash on altcoins. So from meme coins to altcoins to every other thing I've been losing cash on. But yeah, what do you guys think will happen 5 years down the line for your fund, especially like on the primary on-chain, on-chain transaction side?
Yeah, it is a bit, if you think about AI wasn't even how we interact with it, let alone like meme coins and NFTs and metaverse that we're all talking about. So how much the industry evolves. The way we see it is, how does the entire on-chain ecosystem evolve more holistically? And that involves the fusion of TradFi and the crypto ecosystem. And you've seen this both in terms of standards and the risk side of things as well, in terms of the especially with the recent DeFi apps. You're starting to bring interoperability with operational standards in TradFi, with governance, with regulatory standards, which is evolving on-chain. And the reverse, you're actually seeing better potential capital formation models, and as we mentioned here, just leverage moving off-chain from on-chain. So you're starting to this fusion of the best of both worlds coming in. And the way I see this is that when we get to the other side of this cycle, we'll be in a much, much better, healthier place, where we'll have the right products in here and structured in the right way with the right use cases. And the people using them will be hopefully a more mature market with eyes wide open entering every trade.
And to that end, I think that's because there's going to be very much a convergence where you do not know that you are interacting with the blockchain, or you do not know that everything that you're owning behind that screen is tokenized, and that's how you can build, to the wealth management point, a complete customizable asset allocation that's rebalancing on a monthly or a quarterly basis, depending on what your allocations are, and being able to do that 24/7. And also having, I think, global markets too, to a certain degree. There's still a secondary market liquidity issues there, and that needs to build up. But I do think that that will be a huge focus too over the next 5 years. And then obviously AI, elephant in the room for agentic payments. And I've talked about this with a few people. You can, an AI bot is not going to access your bank account, but it can move your stable coins, and that can move in and out of a wallet, and to think about how that could power so many of these use cases.
Yeah, so I would also expect the secondary markets to grow in comparison with the primary markets, because they can be more efficient, and we would just need to have a proper risk duration transfer mechanism in place. So that would be one of my takes. And then I would also expect these tokenized funds to scale on-chain during the next couple of years, not only because of the distribution itself, but because they can be integratable in DeFi, and it generates additional yield opportunities, more DeFi composability, and the process is a lot simpler than what happens off-chain. So I would say that if we build liquidity for that type of asset, secondary markets will grow. Because of that, because of the liquidity guarantees, assets are more composable on-chain, and it will consequently unlock additional DeFi opportunities, and strategies will become more attractive as well for whoever has exposure to them.
Yeah, no, I think the next 2-3 years, I think a lot of capital will come on-chain. We are being very bullish on that as well. We have seen so many market makers, so many players, so many funds doing the same thing, and they are improving. I think that's a good cycle for us. On that, I think, yeah, we are done with the questions. Thank you so much, guys, for taking out the
Thank
time
you.
and coming
Appreciate
here.
it.
Thank you so much.